Okay, welcome back, everybody. Glad to have you here for day 6 of the pullback course. So originally, when we mapped out the course, we were working with 5 days, and we added this day 6 as a bit of a bonus. We wanted to just kind of take a look back at everything we've done, which by itself wouldn't be terribly useful because you can always go back and watch the videos, but also to, some of the things, for instance, at the beginning of the course did not fully make sense or didn't snap together until you had the information later. So this gives us a chance to go through everything and kind of level that, in any bumps we have there. And also we have some really cool charts at the end of the session today. And on that subject, if you're in the live session, if you look in the handouts section, you will see there's a PDF there. So for today, we have assembled the charts from these slides into a PDF, which you probably don't need while we go through the slides today, but some of the slides I'm going to leave you to look at a little bit more carefully. I just want to kind of set you in the right direction there. But if you're not in the live session, then we'll supply this PDF to you separately. So here's what we're doing today: review of the course. We're going to look at trading plan. This is a piece that we have not yet talked about. We'll spend a little bit of time today thinking about how you can take the ideas of how you might trade pullbacks and put it into something that you can lean on and rely on for just a day-to-day trader. And then we'll talk a little bit about some of the psychological aspects, and we've hinted at that through the course. Just want to say a few more words, and then we'll go through a bunch of charts and look at how pullbacks have worked historically. So these are review, and what I did, I went back through the course and I picked out a handful of slides. So let me tell you the story in kind of abbreviated fashion here. Here's how we do the course in a very compressed format. So one of the reasons that people struggle with trading is, first of all, it's hard to trade. And that's and I know that flies in the face of a ton of marketing that's out there. Everybody says, just learn this one little pattern, take this little course, buy this book, buy this special indicator, and you can make tons of money. Well, the reality is that it's harder than that. It's a lot harder than that. You have to put everything together exactly correctly to make money in the market. And it's also worth considering that the market is extremely competitive, that you're fighting against some of the smartest and best capitalized people in the world. And you also want to be careful because, like, and the new traders are very passionate about wanting to succeed, and they should be. If you're not, this is the wrong business for you. But you have to really think, why am I going to succeed? Why should I be able to take money out of the market when it's so difficult? Now, the first thing that I would, if somebody asked me that as a beginning trader, the first thing I would throw back to them is, well, some people do. So it's possible. It can be done. And then the question is, why you? Be careful of answers like, I'm really passionate about markets. Everyone is. That's nothing. And you want to be careful also. Some people will say, well, I'm going to outsmart everybody else. You're probably not. Even with a pretty high IQ, you're up against a lot of pretty high IQ people, and it's probably not a matter of you simply being smarter. It's also probably not a matter of you working harder, and that's a hard one because, particularly in America, we have this idea that the harder you work, the more results you get. It's true to an extent, but you also have to work smart. You have to do the right thing. And the problem with thinking that you're going to work harder than anybody else in the market is that you're not understanding the people you're competing against, because what they are going to do is hire 12 of you. You have 12 people working just as hard as you. So the reason that you're going to make money in the market is because you are able to identify an edge. You're able to integrate that edge with your personality, with the reality of your life. We're going to talk a little bit more about that. And then you're going to do the same thing with perfect discipline, and you're not going to make mistakes. And if you go back and you read about some of the hedge funds that have blown up, it's also worth noting that a lot of really smart people have lost a lot of money in the market, and they've done this through various things have happened, but it almost always comes down to making some kind of mistake. So a big part of your job is not making mistakes. Also remember that the market is a wicked learning environment, and it's not an opinion, that's a technical term. And a wicked learning environment, the opposite is a kind learning environment. In a kind learning environment, your outcome is tied to your actions very, very tightly. If you might imagine, learning to shoot a foul shot with a basketball, you're going to do the same thing over and over and over. And yes, if you're outside, sometimes there's going to be wind. I don't know, maybe a bird hits the, like something will happen at some point to make this not always true, but pretty much whether the ball goes where you want it to go is going to be dependent on how your body is moving. It's not true in the market, because you can do exactly the right thing and lose money. You can do exactly the wrong thing and make money. And it takes quite a bit of data to navigate. And by data, I mean you doing things, looking at outcomes to successfully navigate a wicked learning environment. So you do need to be prepared for that. And this is one of the key misunderstandings that, I sort of threw some shade on the let's say overambitious marketing that a lot of people do. If you understood that no matter what you do, every trade is a random outcome drawn from a probability distribution, then you will see that you're not playing the game that a lot of people think you're playing. But this is the reality of the market, and if you don't understand this, you're not going to make money. You're certainly not going to make money and hold on to it. You might make money on a trade here and there. And to trade successfully, you need to know when to get in. You need to know when to get out. This includes both getting out at a loss and a profit. You need to know how to find trading opportunities. You need to understand position sizing, and we've talked a lot about that. You need the right mindset. We're going to talk a little bit more about that today. All of this comes down to doing the right thing at the right time. That's the thing about trading. It does not matter, and this is one of the places where I depart from some of the big names in trading psychology, because people say you don't trade the market, you trade your beliefs about the market. And I always throw back, well, your airplane pilot is not flying against his beliefs about aerodynamics. Your cardiac surgeon, your vascular surgeon, is not operating on his beliefs about how the body works. There is, now these things are important. I'm trivializing something that actually does have some value, but the reality is there is a reality behind trading. And if your beliefs are not aligned, that's the key, right? If your beliefs are not aligned with the reality of the market, you don't stand a chance. So, you might say that everybody knows the word orthodox. What does that mean? It comes from the Greek, which means to believe the right thing. That's not trading. Trading is orthopractical, meaning that you have to do the right thing. All that matters is when you push that button in the end. That's what your trading account, that's what your results are going to come from. It's just when you pick up the phone, when you push the button, when you actually execute the trade. Speaking specifically about pullbacks, pullbacks are pauses in trends. So this means for a pullback to be successful, we need some kind of trend. Now, we've talked about kind of the classical trend looks like this, right? That's the trend that you'd scratch on a napkin to explain to somebody. And one of the first things that I learned about pullbacks is that the first pullback is the best pullback. I said that in this course, but I also said it's kind of a dumb thing to say, because you can only say that from the perspective of history. And the first time you're sitting there scratching your head, looking at a chart saying, is this the first pullback or is it going to fail? You realize everything is much harder at that hard right edge of the chart. However, there is still utility here. What you need to understand is that there are three places that trend-wise that you could be executing a pullback. You could be executing in the middle of a trend, and those probably are the easiest trends. We've seen that recently, for instance, in the Treasury futures, the 10s, the 30s, the 5s, or the Euro bonds. We've just seen those trend and trend and trend, and we see that in some currencies. The Japanese yen's a good example, where you can just take every pullback and the thing keeps going. It's also certainly possible to trade at the beginning of a trend when you have new momentum. You do want to, and none of this can be done with 100% reliability. That's the qualifier, that if I put the proper qualification on everything, I would say before almost every sentence I say, I would insert, you can't do this 100% all the time, but what you can do is do it right more often than not. And that's all that matters. And that is truly enough. But we do want to be mindful of potential signs of trend ending. That's the value here. It's not so much that we can identify the end of the trend with 100% reliability, but there are some things that happen at the end of the trend. And if we're sensitive to that, then we can avoid some losing trades. Pullbacks also tend to be controlled. This is quite important, that and by controlled, somebody asked a question, who's controlling the pullback? It's a very reasonable question, but it's not the sense that I meant that word in. I meant controlled. The price action is relatively quiet. You will see almost certainly lower volatility. You almost certainly see lower volume. That's a little bit less reliable. You'll see, particularly in terms of the range of the bars, what you don't really see are expanding ranges and pullbacks very much. That's not a pullback. That's not setting up the best trade, because what the pullback does, we think, and this is speculation, but we think that when the market gets too much in one direction and everybody's kind of overextended and maybe tired, mentally and psychologically, the market participants are, then when the market takes a pause to let people reset. And if volatility is expanding, it's not much of a pause, it's not much of a reset. Biggest challenges in pullback trading are knowing precisely when to get in. We've looked at a bunch of possibilities for that and exactly how to limit risk. Do be aware. Here's the qualification again. You're not going to be able to do this 100%. If you try to do this 100%, I will guarantee you what will happen. You will not be a trader, because you will get caught up in, one of two things will happen. You probably will get caught up in this mental game of always punching yourself in the face because your entries aren't perfect. Well, entries can't be perfect. If you'd accepted they weren't perfect, they were not going to be perfect from the beginning, then you would have had the right mindset. But the other thing you can also do is get too caught up in the methodology in trying to make it perfect, and you spend so much time there that you never actually get to trading. So just understand, I'm early, I'm late, I get stopped out of trades that end up working, I get stopped out too early. It happens to everybody, and as you do this more, it will happen to you less, but it will still happen. If you do this for decades, you're still not going to have perfect entries all the time. It's just impossible. Why do we know that? Well, this goes back to that first slide, right? Because if we understand the nature of the market, we understand that it's not possible to do this. You really have to find the approach that works for you, and you have to be consistent. Another word for consistency, or another very closely related word, would be discipline. Momentum is important. If you're going to talk about momentum, momentum is something that can mean several different things to several different people. It, even in some of the academic research, means relative strength. That's not how we mean it here. What we mean with momentum is how fast a market is moving. So one way to think about that, if you were looking at a chart that would be scaled consistently. Of course, this is a problem with modern charts. It's also a strength of modern charts, but as the chart scales, the y-axis, as the chart scrolls, the y-axis will change, so the angles change on the chart. But all other things being equal, different angles will indicate different momentum. There certainly are ways that you can measure this. We've talked about measuring it with the MACD, with sigma spikes, with move to the Keltner channels. These are really good ways to measure, practical ways to measure momentum for pullback trading. New momentum also often shows the beginning of a trend. And this is something that's very important, that when you have a market that's quiet and then you have a big explosion of momentum, one of the principles is that momentum comes before price. So what that means is, if you have new momentum to the upside, chances are you're going to see higher prices. However, expanding momentum also is a sign of the end of the trend. And I asked the question here on the slide, how to tell the difference. It's not that hard. For one thing, if you've been in a long mature trend and then the momentum starts to expand, well, it's not too hard to tell. Okay, we've been in a trend now, momentum's expanding. It's quite different than if you're in a tight range, momentum's been low, and then you have a momentum punch. So this is not as hard to untangle as you might think it would be at the beginning. Let's give some ideas here. I said this, but thinking about how to measure momentum. You also certainly can do it just by looking at the chart. I don't find that that's even after looking at who knows how many hundreds of thousands of charts over the course of my career, I don't find that to be quite as reliable as using something like Sigma spikes to quantify momentum, because your eye will do a pretty good job, but I like to be a little bit more consistent there. And I'm telling you that as a discretionary trader, that I'm fine being very subjective on many measures, but whatever you can nail down to drive toward consistency is generally a desirable thing. So we talked in previous sessions more extensively about how to measure momentum. It's definitely worth spending some time on that. Trends begin with a momentum spike. They also, to be perfectly fair, so you have a market that is ranging here, and then you have an upside break. So that move would be made on new momentum and would lead to ideally further trend legs. There is also the possibility that the trend just kind of starts slowly. This is unusual. In fact, this second possibility, while it does happen, is not particularly tradable, and I don't think you should spend too much time thinking about this, because what you're not going to really catch those first pullbacks where you see this new momentum just sort of starting to develop. What you might do with a market like that, you might come back to it and notice, and in reality you're evaluating all the time, but at some point you might notice, hey, the thing's actually trending, and then you switch into trading pullbacks in an established trend mode. So it's not quite that you have to catch the beginning of a trend. And this one is hard enough to trade. We didn't spend a lot of time on it in the course because I would not look to trade pullbacks out of that. This is not really a problem. You do need to be prepared in many cases. This is a critical trading skill. A lot of people will tell you, so, okay, here's one of the ways that I think some trading advice goes wrong. People will tell you, you got to catch every trade. You can't miss any trades. Have you been told that? Of course you have. This comes from a trend following approach, like a turtles style. We talk a bit about the turtles in the course. For that style of trading, you might have 80 trades throughout the year, and all of your profits come from 2 or 3 trades. So for those people, they cannot miss trades. It's a different profile, but people don't understand that when we're talking about pattern trading like this, it's quite a different game, and the probabilities line up differently. I said this is all dealing with a probability distribution. These trades look different. So one of the critical skills for a pattern trader is looking to looking to be comfortable, I guess maybe that's the word, with missing this first pullback out of a trend, and not thinking that you have to catch every move. That's kind of a critical trading skill. Just a look here at this is a chart that we've seen before, but here's a pretty clear example where you have market breaks to the downside. You would register new lows on the MACD. You also go through the lower Keltner, which you really have not done in previous history, and this led to a downtrend. And this is crude oil fairly recently. And then at some point we start to see new upside momentum. The MACD gives us a measure of new upside momentum right here. Now, again, I'm not saying that you could trade that, but once you've gotten up to the upper Keltner channel, you do start to see kind of standard pullbacks, and this thing trends for a long time. So, this was a kind of watershed moment, and it's very interesting and instructive, I think, to spend a little bit of time. You can pause the video, spend a little bit of time, and look at this chart. How trends end, this is very important. We talked a lot about this. I'm not really going to go through this in extensive detail today, but we spent a lot of time looking at climax. We talked about climax on 2 different sessions, spent quite a bit of time. Rollover, strong counter trend shocks. One thing that you should not see is, so like look here, we're in a downtrend, right? But between these bars, we're in a downtrend. And if you look, you don't see a lot of upward sigma spikes, and you don't see a lot of big upward sigma spikes. The big volatility is in alignment with the trend. And that's a principle. It's not a 100% thing, but you do definitely want to be alert if you think you have something. Let's just say that you're holding on to stock that you think is going to do very well, and you start to see over the course of several weeks or months that there are some really strong downward shocks and measured by sigma spikes. You might rethink the trend integrity there. That's a specific issue. Specific failure patterns also, I said failed breakouts, but you could add to this the patterns that you now know that are associated with, that's supposed to be a PB, so pretend I wrote pullback there, with failed pullbacks. Climax trend generally accelerates. You have the trend doing its trend thing, and then it goes like this. And a lot of people, when they see that whoosh, they think that things can keep going forever. It's actually a sign of a market becoming one-sided, overheated, maybe running out of steam. Volatility increases. You can measure volatility lots of ways. You also can just see the range of the bars tends to get very big. Free bars are quite common. Free bars are bars that are completely outside the Keltner channels, and climaxes are often followed by dramatic reversal. So here's a climax in gold up here. Look at this. We've been trending kind of like this. We're just drawing a very imprecise trend line, and then all of a sudden, boom, we go vertical, right? And if you don't know any better, and I can laugh because it's how I started trading. My first trade was something stupid like that. If you don't know any better, you think, oh, it's going to keep going forever. It's probably not. Notice also we have a few free bars here, and generally speaking, free bars are unusual. There's another free bar over here. Whenever you see a free bar, unless we're in a specific kind of trend dynamic, which we haven't really talked about in the course, but a slide along the bands trend, you will see more free bars. But if you have more of a normal trend like this and you see free bars, many times that's a measurement of at least some degree of overextension. And you see the climax here, strong counter trend shock. That's a very typical pattern. And also, once we start to see this is middle end of 2020, once we start to see these large downside shocks start to emerge against this uptrend, it does maybe tell us something about the next few months in gold. You can go look at how that played out. One thing you do need to be aware of is that sometimes when a market has a big shock, that you have this kind of climax thing, and where you have trend, climax, and then you have a big shock, and you spend a lot of time consolidating here. One possibility after a consolidation is it is possible we might just continue higher. And this is one of the principles that is at work in complex pullbacks, that sometimes when the market gets way overextended, it just needs a little bit more time to reset. We talked about pullback variations just to illustrate these here. Simple pullback is exactly what it says. You have a trending market that makes a simple pullback. That's a simple pullback. A complex pullback has multiple legs, so it looks like that. That's kind of the classic pullback. What it really has is a little pullback inside of a pullback. Do be aware that sometimes complex pullbacks can give you garbage like this. There's no guarantee that you're just going to see this and it's going to head higher. Sometimes you can have a lot more legs. Nested pullback is when the pullback starts working and then you have a pause. Typically, it's not actually a pullback. It can just be an inside bar. It can be a little tight range, but it's a little bit of volatility compression that is in the issue. The point, it's not an issue. The point of a nested pullback is that it's a pause in the momentum from that bigger picture price structure. Fast and tight pullbacks, we didn't talk about that much. They're a little bit difficult to trade, but those are exactly what they sound like. They're pullbacks that are maybe just a few bars that are near the extreme. So they don't really pull back, they more just pause. And then the ante we talked about, and I won't go through that today, but I will tell you it's important, and that's why we spent some time on it in session 5. So you want to go back if you missed that. You want to go back and spend some time there. Choosing specific patterns, you want to see that pullbacks are controlled. You don't want to see that some of these things, there's a common thread, right? You do not want to see new volatility against the trade. So generally speaking, if you're looking at a bull flag, so the market goes up, comes down, you're buying it, bull flag because you think it's going to go up, you don't want to see a lot of like big downward spikes in that. First of all, if you do, it will probably violate the pattern, but it also shows that it's not really a controlled pullback. You also do want to be careful of the trend ending patterns, because even if the trade works, you're likely to need to spend a lot more time consolidating sideways. And that's no fun. Those don't tend to be the cleanest trades, and you simply could have trading rules that have avoid places where you see evidence of the trend potentially ending. Risk is uncertainty, possibility of gain, possibility of a loss. I think it's very useful to think in terms of scenarios. I tend to think in 5 scenarios: flat, up, down, and then big up and big down. Make sure that your big up and big down include some potentially kind of crazy things, because you want to make sure that you capture all of the possibilities, and markets are capable of making bigger moves, crazier moves than we would ever imagine. Position sizing. So we spent a lot of time on this, and I think you should go back and watch the discussion, but just understand that this is a really important question to answer. And if you get it wrong, this is one of the ways you can do everything else right and trade too big and blow out your account, even with a very profitable system. So you want to make sure that the goal of position sizing, I think I use the Goldilocks thing, is kind of like, you not too hot, not too cold, not too hard, not too soft, not too big, not too small for position sizing. Because if your position sizing is too big, then your even profitable system, a pullback can destroy, or pullback in your equity curve, a drawdown can destroy you. And if you're trading too small, you're simply wasting your time. So you have to find the right answer. And we looked at all of these possible approaches, and we ended up saying that fixed fractional is probably the best answer for most traders. You could make a case for some of the others with some specific types of trading. Do be aware that fixed fractional means the risk. So the amount, and the way to think about this is the amount of money you would lose on each of your trades is the same percentage of your account size. That is not the same as saying the amount invested, and that's a common mistake. But the way to think about it is, okay, if this trade loses, if my stop is hit, then what will be the dollar amount of that loss, and then look at that dollar amount as a percent of your account, and you want that to be equal. So what this means is when your account gets bigger, that dollar amount gets bigger because it's a percentage of a bigger number, right? That's the magic. That's what allows for your account to grow. Do be aware that if you're using fixed fractional, that the actual sizes, I'm saying the nominal sizes here, but the dollar amount invested in your positions can be really very, very different. The goal is to normalize the outcome of each trade, not the size, not the volatility. We talked about R, and so what you do with R when you get into a trade, let's just draw a pullback here. Let's say you buy here. So you buy here and your stop is here. I'm just going to put an S there. So there's your stop and there's your entry. That distance between your entry and stop is R. And it makes sense to think about each of your trades rather than talking about them in terms of, hey, I made $4,000 on that trade. Say I made 0.8 R, or I lost 0.3 R. So if you think in R instead of dollar amounts, well, for one thing, it will let you think about it's not quite the same, but it'll let you think about a $10,000 account the same way you think about a $100,000 account. So it lets you be consistent across different account sizes, and it's also a very good way to normalize your performance. If you tell me at the end of the year, I made $8,000 trading last year, I don't know what that means. How big was your account? How many trades did you do? But if you say, I made 20 R over the past 8 months, then that's a different discussion, and that's it's just a little bit more of a in my mind, I would say a professional approach to understanding your performance, but it's really designed to also remove the impact of dollars and to remove some of that. Finding the best pullbacks, you got to answer all these questions, and we spent a lot of time talking about the best pullbacks, looking at examples of what we're looking for. I'm not going to really get into this on this slide, but I will also point out there's a certain amount of implicit learning here. I mean, and that's why we showed you a lot of patterns, and we talked about a lot of patterns, because over time that really does become a thing where you've seen so many of these things that you start to know it when you see it. And you can't, I don't think that you could train somebody by just showing them thousands of patterns. I think you have to have a little bit of the idea of the theory behind it. But when you have both of those things, when you understand the theory and you see lots of examples, like some really powerful learning happens. That's pretty exciting. What markets to trade? We've talked about this too. One of the things that you want to keep in mind is that even markets that we would think typically might not trend very well, when there's an imbalance in the market. I mean, when I say imbalance, I mean an imbalance in buying and selling pressure. When that kind of imbalance develops, those markets can work very well for pullbacks. The nice thing here is that the approaches that we have talked about to find pullback trades, basically waiting for big movements, waiting for the market to tip its hand, is the way to think about it. That more often than not indicates the presence of an imbalance. So you don't even, if you're using the tools and the ideas and the approaches that we've talked about in this course to find pullbacks, you don't necessarily need to spend a lot of time agonizing over how well the market's going to trend, because we've done a lot of that work with finding the trades. It is also, worth maybe giving a little bit of thought to some of the markets that do trend best, and we talked about that too. The specific entry is the most challenging part for many people, and I would feel reasonably safe saying that for most of you, this will probably be the piece that will come together last. You'll get it eventually, but you'll get most of the other aspects of trading pullbacks before this really snaps. And we looked at a bunch of specific entry patterns. And let me just go through these here, because I think this is, it's probably not a fully comprehensive list, but it's a pretty good list. So we can look to enter anywhere after the market, let's say buy. So the market goes up and touches the upper Keltner channel and then comes back, and you can buy pretty much anywhere there. Now that's extremely subjective, and it's probably not best. So number two is quantifying that a little bit. You go up, you touch the upper Keltner, and then you buy somewhere specific, a touch of a moving average. It could be the middle of the channel. Could also be I played games for years with different channels, like triggering off of a 2.5 or getting the setup off of a 2.5 channel, and then coming back and actually triggering the entry off of a 0.5 or something. So you're drawing a band that's closer around the moving average for your entry. And then you can also set your stop from a Keltner. If you want to play those games, you certainly can do that. You can look for inside bars. You can look for a failure test. The problem with both of those is they don't happen all the time. You can look to buy the upside breakout of an interesting individual bar. Of course, the question is, what is an interesting bar? And we've talked about lots of variations of that. You can buy a break of a pivot. We've looked at specific geometry there. Also break of a trend line. Those two things are closely connected. The advantage perhaps of the pivot, which you might turn around and say, okay, well, no, that's actually an advantage of a trend line, but the advantage of a pivot is, let's just draw one here. So, okay, so you had the market that goes up, and then you have your pullback, goes up and leaves a little thing like this, and I'm suggesting that you could buy above the high of that bar there. Another possibility is to draw a trend line over that, and the problem with the trend line is that it's not something that everybody sees. Everybody's going to see that pivot, and that is a point where you might reasonably expect other people will take some action in the market. Certainly not guaranteed, but is possible, is maybe even likely in many cases. And the trend line is just a line on the chart. So be aware there's maybe a different degree of reality. We talked about the first cross on the MACD, and we also talked about using a nested pullback. This first cross definitely bears some consideration. Let's look at all of these on this chart. So this will also illustrate a couple points. So the first cross happens when when I did this before, I took the time to do different colors. I'm not going to do that here. Here's the 0 line of the MACD, okay? And here's this, I'll use dotted. Here's the slow line of the MACD. So the way the trade actually works is, here's your fast line. So, pretend that's not there. Okay, so here's your fast line. The entry is the first time the fast line comes back to 0 after the slow line goes negative. So that's a first cross sell. You also have another sell here. Any other time we come back is a potential setup. And then you have the first cross buy would be here. So it's and you see the issue is that right here, you can't see my lines because they're all the same colors, but that the slow line goes positive, showing the momentum is positive, and then the fast line comes back to 0. So there is your, there's your buy. Now let's look at this on charts. So this also needs to line up with the chart pattern. That's one of the keys. So here's your first cross sell. I'm assuming, we can't see what's off to the left, but almost certainly is. And that lines up with looking to sell here. Good. Okay. So here we have a first cross buy. Now, would you have bought here? Is that actually a pullback to buy? I would say probably not, because we did not really get up there enough to the Keltner channel, even though this particular trade probably would have worked. That would not have been a trade I would have looked at. Look here, this is first cross sell is here. So this happens here. Is that a point you're interested in selling? Well, you already had a trade here, right? And now we're setting up a complex pullback here. So this is not a perfect tool. That's the point. And I would defer to what I see on the chart, but and also, this is close enough, right? Maybe if you were executing a first cross, you would not have actually executed the first cross there, but it's certainly close enough that the trade effectively happened. So even though this one worked, this is not what I would be looking for if I were looking for the best trades. First cross buy here. You got to buy that? Of course not, right? See, so at this point, you should also be thinking that. You should say, no, Adam, it's a stupid trade, because it's not a controlled pullback. First of all, do we really have enough upside momentum to set up a pullback? Yeah, maybe. Clearly new momentum high on the MACD here. Didn't really get up to the upper Keltner. I don't love that. But we could have looked to buy a pullback, but it's not a pullback. It's a 2-bar collapse from the high. Okay, so that's not a trade. How about this? It's a sell somewhere in here. It's pretty nice, right? Here is a second cross sell, and I don't think about them like that. I don't think first, second, third cross. I do think about the first cross, then I think about others, and there's probably very close to momentum divergence there, but we also discuss momentum divergences, and we don't have a review slides on those, but that's not a signal that we look at. So there's the MACD. We hit every one of those patterns there, and that's also how I would think about it. I would also point out that if you're looking, let's look at spikes for trend integrity, you're pretty much clearly in a downtrend from this point, right? And we do have some large upward shocks, but not that many, and most of the big sigma spikes are to the downside. And this was a point where when we started to see this, you might have thought, what's going on with this market? Is the trend turning? It seemed unlikely given what was going on with interest rates and in the macro environment, but it was possible. However, once we were wondering that, this action here showed us, no, it's not great. By the way, nested pullback. That entry, that little inside bar there is a good short entry. Look here, inside bar, good short entry there. Nested pullback, well, we just did that, but there's some others listed here too that you can take a look at. So we talked about using options. I laid out using verticals, and I think there's many good reasons for using verticals. I also suggested that if you're in trades for a relatively short amount of time, you might want to consider just single strike puts or calls. Go longer dated. The only reason for that is the time decay will be less. Now, a lot of people will not like to do that because those longer dated options cost more, and they want to be able to like post huge percentage returns on their options, but that's not what you're looking for. What you're looking for is something that's going to hold its value for the time you're in the trade, and you'll still do the trade with less money invested than if you were than if you were doing it by buying stock, even on margin. We had talked about a model of post pullback action broadly divided into success, trend extending into multiple trend legs. That's success, right? When you get something like that, that's success. Do be aware that you could simply have this move, that success. Getting past that previous pivot at all, touching the previous pivot is a kind of success. Reaching 1R is a kind of success, but that is more subjective because that's not going to depend on any chart geometry. It's going to depend on where you get in and out of trades. We also looked at failures, and I suggested these three, what I consider to be classic failures. I put them in my book, and I don't think anybody had ever laid them out like that. So, maybe me calling them classic is a little bit arrogant, but I think I think it's held up well enough we can. The failure at the previous pivot there with number 1, the failure by strong momentum against here with number 2, and we spent a lot of time looking at these in a previous session, and the failure by the market going flat in number 3. That captures most of the possibilities for maybe captures all the possibilities for how pullbacks fail. Trade management, you got to think both about your protective stop. You got to answer all of these questions. Where do you put it? When do you raise it? Will you ever widen the stop? Will you use profit targets? What do your profit targets look like? Will you trail stops? We did a lot of work on trailing stops. I made the argument for using a fixed R profit target, even though you won't have these big gigantic wins. You will drive toward consistency, which is highly desirable in a very inconsistent and random market. So this is a little bit new. Let's talk about trading plan. We talked a lot about trading pullbacks. We looked at a lot of different aspects of trading pullbacks. If you're going to make this work, you're going to make it work through disciplined application. And you cannot, and what does discipline mean? If you say you're a disciplined trader, what that tells me is that you're following the plan. You can't follow the plan if you don't have a plan, right? So it's very important to formalize all of this into a trading plan. And I think in my own trading universe, in basically 3 levels of a trading plan. I think of a business plan, which does include some personal stuff, some schedule stuff, some things that, maybe even border on the spiritual, like, how I want all of this to fit together. It also includes, like how much money am I going to be able to, how much money and time am I going to be able to devote to my trading activities? So you map that out in a formal business plan, and even if you don't intend to present it to investors, it is you're doing the same thing for yourself that you would do if you wanted to open a shoe store or a bookstore or whatever. You're creating an actual trading plan for a business. We're not going to talk that much about that. I would also suggest that you need this kind of intermediate document, which I call a CRG sheet. And what this does, it looks at different kinds of trades. And this might be, pullback trading might be one of these kinds of trading, but you might also do algorithmic trading. You might also do some long-term investing. You might do some different kinds of options trades. So you have like this document that, kind of, not really flow chart, but kind of flow charts your trading activities like that. And then the setup sheet. I think this is where you should spend time. What you need to do is look at everything that we've talked about with pullbacks and create a precise set of rules for yourself. Now, with some styles of trading, and it's possible with pullbacks, you might create precise enough setup sheets that they basically could be programmed. So you're creating an algorithmic system based on based on the setup sheets. One way to think about this is you want to explain this with enough detail that you're writing a great trading book. It's also possible, I'll just give you a couple examples here, and you can pause the video and look. It's also possible to leave room for discretion, but that needs to be, the challenge of discretion, of course, is that it needs to be as clearly defined as possible. A good setup sheet will include the setup. It will include the trigger, and I took this from other documents we had, which had some things redacted, but I think you can see here that the magical system we were hiding was the first cross of the MACD. So the setup is the slow line crosses positive. Note that you can only buy if the slow line is above 0. The trigger is the first time the fast line comes back to 0, you're permitted to buy. And then I give a number. This is an old sheet of mine. I have a number of possible triggers, stop loss placement. For now, use about halfway between the moving average and the Keltner channel. That's what's hidden there. Time stop should also be used. This was used for intraday trading. Profit target, and you can see. So this, I don't know how old this sheet is. This probably comes from I don't know, 2004, 2005, and we're still saying a lot of the same things, right? Remember, this is a play for one swing only. We discussed that in trade management. Initial profit target is at the previous swing high. So you're seeing a lot of the same things, right? And I'm doing half exits here. And most important, this is actually very good advice. Thank you. Don't take a loss on the second half. Additional considerations, look at the chart pattern. You want to see strong upswing to set up the trade. Price touching the upper Keltner channel will add confidence to the setup. Be careful of doing these if they set up after that probably was a climax. I don't know what that was there, but so this is a pretty solid setup sheet example, and using a trade that we know. Setup sheets can also include more, and I won't read this list, but these are things that you could have in a setup sheet. Here's another example of the same thing. This was traded on 5-minute charts. The S&P futures were at 800. Look at that. And here you see explicitly what it is, and this is using charts to illustrate this. This is back when I used ADX, which I no longer do. Going from theory to practice, so we covered this. It's worth touching on this again. Just be aware that the key here is you want to make yourself earn the right to trade bigger. Everybody wants to trade bigger. I've had more than a dozen times talking to struggling traders who have told me, the conversation goes like this: I'm losing money pretty consistently. How do I get bigger? That's a strange question, right? You got to get profitable before you get bigger. And if you do this right, you can, it's not seamless. You'll definitely go from, you have some speed bumps along the way, but basically you verify your system in paper trading, and then start trading really, really small. And once your results are good, it takes time. That's the trade-off here. It does take time. Once you have done this, then you can gradually increase your size and start firing for effect. Monitoring your performance on an ongoing basis and watching for problems either with you or some systems do stop working. Some systems need to be tweaked. Parts need to be moved around. Parameters might need to be changed. And if you're watching your performance, monitoring your performance, you will see that. Just a couple words on psychology. So this is very important. Ultimately, you're not going to be successful unless your trading psychology is properly aligned. And I think the mistakes, many of the people who teach and focus on trading psychology are psychologists. That makes sense, right? But the problem is they're not traders. So they focus on one aspect of this, and in reality, both aspects are important. Both aspects being your psychology being properly aligned for you, and your psychology being properly aligned with the reality of the market. You have to have both of those things. There are certainly systems that are viable and profitable, but you might not be able to trade them because it's just maybe it's an approach that's too fast or too slow. Maybe it takes a kind of risk. Maybe the distribution of wins and losses is not what you want. Maybe it's not enough action, too much action. That's what I'm saying. And so you really do have to know what kind of trader you are, what kind of trader you want to be. And I don't think there are any shortcuts to this. I think you can sit down, you can take surveys, you can think about, one of the best tools for this, I think, is journaling, like actually, and I would say paper rather than computer, but sit down and write, just, have a conversation with yourself about what kind of trader you want to be, what kind of risk you're comfortable with, what goals you have, how much, what are you willing to expend in terms of time and energy and focus, because we do only have 24 hours in the day. And the other thing that I would say is, a lot of success in trading comes down people using the word grit now, and grit meaning that you can fight through pain, you can fight through adversity and disappointment. And I think anybody who trades for any period of time, you're going to have a few of these moments where you're lying awake on the sofa at 5:30 in the morning saying, well, shit, I probably can't do this. Like, I don't know, I thought I could do it, my dream is dying. That's part of the normal process here, and you got to plan for that. One of the things that I have found very useful is to remind myself. Part of this is managing your self-talk too, right? You're going to go through periods where you think you're the best trader who has ever walked the planet. Almost every trader thinks that at some point, and the danger of that is hubris. The market gods punish hubris, and they'll punish it by your actions. You will trade too big, you will ignore warning signs, you will put on too many correlated positions, you'll stop doing the homework, and so, like, all of these things will happen, and you'll get a gigantic punch in the face and maybe end up destroying your trading account. So those moments where things are going really good and you're feeling really good about yourself, that's a really dangerous moment. So be very careful. One of the things I tell myself is that when things are going well, I'm not as good as I think I am. You kind of have little the little devil sitting on your shoulder saying, okay, you're not as good as you think you are. I don't know which one's the devil, which one's the angel. But and also the other side of this, though, is when you're struggling and when you're in drawdown, and you're usually going to be in drawdown in your trading account, and you just think this is hopeless, and you think you're the worst trader that's ever walked the planet. Also tell yourself it's not as bad as it seems when you're in those darker phases, and the reality is somewhere in the middle. The extremes of psychology are very dangerous, and that's what we think about. We think about the elation of success, or we think about the grinding pain of loss. And so we tend to focus on those extremes, but you want to do everything you can to push yourself back to that focused middle. And I do think that there are a number of techniques. There's nothing wrong, by the way, if you do find yourself struggling with trading issues. A lot of times they can kind of set off a little bit of an avalanche of some other life issues. There's nothing wrong with seeking some professional help, going to therapy for trading issues. Traders do this. There's no shame in that. And I think that most traders who are really serious about long-term success do spend some time thinking about their own mental health. And it depends how you're wired. For some people, maybe therapy isn't the answer. Maybe long hikes out in the mountains, but you got to do things to take care of yourself. And I guess the last thing that I would say here about psychology is that your path to success will kind of look like this. It's a long, winding path, and there are going to be times that you sit down and take breaks. We would love to say start here and then just go there with like the straight Roman road, right? That's not the way it works. You almost certainly will take some time away from trading along this path too, and that's okay.
A lot of people think when, if I need some time to step away and reset, that means I failed. Not at all. That's a normal path for a trader driving towards success. So here's what we did today. I want to look at some history, but I will do some lightning round questions with the questions that are here already. Okay, so let's just go through a bunch of questions and I'll do them fast. How do you distinguish between a failed pullback and a complex pullback? I don't think there is a distinction to be made. A complex pullback is by definition a failure of a simple pullback. The question is, how do I tell if the complex pullback will fail? And there's no way to do that with the reliability, but everything we've talked about should drive you toward being able to manage those trades appropriately. At what point does a potential complex pullback become a failed pullback? Well, we've identified those three patterns of trend or pullback failure. So you're looking at the strong momentum against, and at some point, if it goes flat, and you should define that in your trading plan. To some extent, you'll know it when you see it, but you definitely should quantify that as much as possible. Are trend lines helpful in defining the boundaries of a pullback and consequently identifying when a pullback has failed? Well, it's not something we spend a lot of time on in the course. I don't think it's one of the more useful tools. There are times that I pull it out and use it, but and you should experiment with it, but it's not a primary tool. How do you distinguish between trend strength and climaxes? We talked about that a lot. I think that should be clear from the section on climaxes. We've really spent a lot of time on that. Do sudden large momentum moves out of sideways action have an edge for continuation or mean reversion? We also talked about this, a slight edge for continuation. If you just look at every big move in markets, you'll see there's an edge to mean reversion. But if that comes out of compressed volatility, there's an edge for continuation. That's why that first breakout out of a sideways range does give an edge for trend continuation. How about large momentum counter trend moves in trending market? We talked about that quite a bit today. What are the strongest statistical edges in the market? The easiest to quantify are mean reversion. You said you're thinking about options as evolved. Yes, but I also said precisely how, right? That doesn't invalidate anything else we've said. It's just another possibility for driving towards simplicity of execution with the offset of accepting a little bit of time decay to pay for that. And we don't recommend any particular broker or charting software. We use TradeStation for most of our charts, but we do our research and, generally speaking, in Python, some of it in Excel. If a trade is 90% toward the 1 hour profit target, is it wise to close at the profit, or should you let it run? That should be in your trading plan. Generally speaking, I would let it run, but we have had kind of a nasty run of things that reach that and then reverse significantly. So I don't think there's anything wrong necessarily with pulling the trigger to exit something that's very close to 1 hour and can't quite get there. On what time frame are you measuring the momentum on the time frame you're trading? So if you're trading daily bars, you're not looking at 5-minute momentum. You're not really looking at weekly momentum. Conversely, if you're trading weekly charts, you're not really looking at daily momentum. So you're measuring momentum. Everything's on the time frame you're trading. We also have not talked a lot about multiple time frame analysis, and that's deliberate. Given the random nature of the market, and it's always easy looking on price action after it's already occurred, how to best distinguish the nested pullback from general market noise in real time? Well, it is possible. I guess I would say that. It does, and you say especially if nested pullback's only 1 or 2 bars, it seems kind of difficult. It is kind of difficult, but we pull these out with a pretty high degree of reliability in the daily videos we do. So we do this in real time. It is possible. I think the probably where to start with this is looking at the bigger picture pattern that needs to be pretty dynamic. Do you use checklists or some other methods you keep to your plan? I have in the past, absolutely. Do you have a program or software that helps keep your plan in place? I use Microsoft Word. Do you have any good suggestions on how to keep you on your plan? It's a case where a coach can be helpful, but you also can just evaluate yourself on a regular basis and ask yourself if, am I really following the plan? Perfect explanation about the first cross MACD. Thank you. Down markets, or as you likely use puts, is IV increases usually. Okay, so you're into one of the other issues with options, is that as the implied volatility changes, the price of the options obviously going to change. So I would be, generally speaking, very careful to stock specific, by the way, not so true in commodities. But if a market makes a giant move down, commodity, this could also be to the upside, it's more symmetrical there, the options will get very expensive. However, as the pullback happens, you know what happens? The implied volatility usually decreases. So you're not buying that like max spike of implied volatility. And this is the other moving piece. And this is also one of the reasons, if you think that IV is extremely high, that could be a good argument for using a vertical in this case, because you're also going to offset much of the impact of that, if not all. But generally speaking, if you're looking at a moderate pullback in a reasonably trending market, this should not be a huge factor. And also depends where your profit target is. There's also a chance that as that move starts to develop out of the pullback, you'll see a corresponding move in the implied volatility in favor of your trade. Should a beginner focus on a specific setup and trigger for consistency? I think the problem is that you may not get enough cycles. You may not get enough trades to really drive you toward consistency if you just focus on one, but that's a good place to start, at least for paper trading. And then I would add a few. And you see a lot of these things are really, everything we've done here has really been one trade, and it's maybe different angles of looking at the same thing. Thinking about price acceptance and pullback failure by going flat. How many bars is too many bars? I look at a lot of charts. I don't have a specific rule, but I do have a strong discretionary sense, and I think you can develop that same sense by looking at looking at a lot of charts. What's the maximum portfolio stop loss we should define? I don't know if you're talking about correlated positions or like max to where do you stop trading when the drawdown's too big? I think if you're asking about individual position sizes, we covered that in fixed fraction, and I suggested that the right answer for most traders is probably between 1% and 3% for an individual trade. Can you use inside bar for complex pullback entry? Yes. Do you consider momentum divergence to invalidate a pullback setup? There were 4 slides in the first session where we looked at momentum divergence. And I explained why we don't think about momentum divergence. So if you missed the first session, Tom, I think it was the first session, right? If you missed the first session, go back and check that out there, but it's not a signal that we look at. Will we have access to previous presentation files? We're not putting most of the PowerPoints out there, but you do have the slides from today. You have the charts from today. I have doubts about the failure of the pullback in the pivot. It's a good place to have doubt. How do we differentiate between the noise and the swing high and an action that can lead to failure? I tried to talk about that on day 5, where we were looking at action around that previous pivot, and I said that you do have to be aware that's a point of uncertainty. And I think one thing that you do need to be aware of is that you're likely going to have some action there, so you probably need to give the market a little bit of room. Now, exactly how much room, that's an element of fine-tuning your discretionary approach. And I don't think it's possible, at least for me. I have not quantified that down to a precise set of rules, but I think you could definitely drive toward that. Could you say more about stock screening criteria might be used to look for the best pullback opportunities? Whether there's any difference between large cap, mid cap, and well, we pretty much just focus on liquid stocks, and we don't really do much with penny stocks and micro. They're so thin. We've done some small cap work, and we've used basically the same tools there. They do trade a little bit differently, so the liquidity filter is an issue with smaller cap stocks. Much of our stock screening work is proprietary, and I can't really give out specifics, but we already talked a lot about the concepts that go into that. I haven't spoken about pullbacks on weekly charts. Do they work? Yes, absolutely. There's some people who, problem is you're not going to have a lot of trades, but there are certainly people who we kind of think of it as mountain man trading. Meaning you go up in the mountains, you check prices once a week, and it certainly is possible to trade on that time frame or even longer. Do I have a max total risk in the market? Example, 6 positions, 1% risk. Yeah, you should have that rule. Reasonable range for positive expectancy per trade and swing trading. Well, of course, it depends on a lot of things, but you're looking at numbers, 0.1 to 0.3. You need to make sure it's economically significant too, but those numbers, that's reasonable. You might be able to do a little bit better depending, it's one thing what you'll see in a back test, of course, in your realized results, but I think the upper end of your range is realistic and you maybe could do even a little bit better than that. What's the expectancy of this pullback system? There's a lot of things to quantify, right? We have not given, you could not possibly calculate an expectancy without having a precise rule set. And what we've taught here are principles that you can put together in lots of different ways, depending on how you want to trade, what time frame you want to trade, how you want to get in and out of trades. And we've looked at the the subtleties of that. If I were to calculate an expectancy, it would be based also on my discretionary inputs, which are not super useful to you. But I think you have all the pieces here, and I think you have everything that we look at to put together that. Doing nothing, here's a place to start. You can do nothing but test when you touch the upper Keltner channel or you have some other measure of volatility explosion, and then take some trigger. If you want to quantify, take some pullback trigger, whether it's a moving average or you can define anything, and that's a place to start teasing an edge out. And if you want to quantify it, and you should, but you also in my experience, the best way to trade this market tendency does rely on a certain degree of discretion. Okay, let's jump into a little bit of history. So I'm going to briefly now just point out all of the pullbacks on these charts. And you'll see that we're covering quite a bit of market action here. And let's use the principle that we want to be mindful of end of trend action, but we also want to be very interested in buying a pullback that touches the upper channel. Now, one thing we see here is that we have lots of points here where we have pullbacks that have not touched the upper Keltner channel. This is the first place we see a touch of an upper Keltner channel. Here's a nice complex pullback. Here's maybe another touch of a Keltner channel, but not really. I'm going to erase these lines so you can see that's not quite close enough. Also, you do want to be a little bit suspicious here, but this points out that how many pullbacks have we had? Well, depending how you define them, here's maybe a little nested pullback, right? A lot of pullbacks. So, excuse me, one thing about stock indexes is that they can trend a long time, and you might find yourself taking the 8th or 9th trend trade in an index, and you should not be shocked by that. One thing, if you're uncomfortable with that, you can wait for a bigger complex pullback, and then this makes this quite an attractive entry. We did not get great trend continuation here because you're in a mature trend. This is S&P back in 2006. We do appear to maybe be having a little bit of rollover here, and we leave this chart that's here, and you can see that in early 2007 we have this gigantic sigma spike shock, and you did have, look here, touch the lower Keltner channels. This is a successful trade if you're trading to that previous pivot. Price rejection at the previous pivot, new upside momentum. We don't really get into the upper channel until we get here. Multiple pullbacks, and then we start to have some action that kind of looks like topping, right? We have a strong move down, and we have multiple attempts to break out of both sides until we decisively break out of the bottom in late summer of 2007. By the way, this chart kind of looks like recent action in the S&P, definitely worth considering. Point here is these next few charts are the bear market, and bear markets don't necessarily move like people think. There are a lot, look at this action. There are a lot of spots to buy in bear markets. You have to be extremely disciplined with your short entries. This chart ends in April of 2008, which is here. Here's where the, so you're in kind of a nasty bear market, but there's still a pretty decent rally. Notice how many of these pullbacks don't quite get to the lower Keltner. This is a slide along the band's trend, which is not really tradable that well for pullbacks. Little bit of volatility expansion. Look at this into the end of 2008. So look at the range of these bars and look at the range of these bars. So that is a little bit of a warning sign that we are becoming a little bit climactic, and that's here. Multiple attempts to bottom, but even with this, you still can trade these little pullbacks if you do nothing more than wait for a reasonable move to the Keltner channel. Why are you not trading a pullback here? Because you had nasty price rejection, right? But this would have, you certainly could have navigated this bear market. There's only a few spots where you would have had clean pullback entries to the downside, but they were there. And it would have kept you out of a lot of trouble, would have kept you out of, you're not trying to buy this market because we can't get back up to the upper Keltner channel, right? So, this avoids being on the wrong side of a trend. I'm flipping back now a little bit. And then once we did bottom here in 2009, up to the upper Keltner here in early mid 2009, and then you can see back to kind of business as usual. Now it's always a little bit strange to compress so much market action into, we just looked at years here in a few charts, right? But the point is that these principles, these pullback principles, have worked for a very, very long time. Just continuing with a little bit of the S&P action, you can see that this is not the kind of thing, you're not really looking to trade this kind of climactic, potentially climactic action. You really need, and is this a tradable pullback? I didn't do it in real time. Well, I think I did actually. That's not typically what we're looking for, but you can see that you have to be very disciplined in your points, because here we are looking from December of 09 to midsummer of 2010, and there really were not a lot of great pullback setups here, and so you don't force trades. That's certainly one of the key principles here. And then later in 2010, notice some of these bigger pullback structures, nice little nested pullback, inside bars here, potentially some pullback action here. Let's fast forward. Actually, you have these slides now. You can go through several more years of the S&P. I also want to point out crude oil here, 2016. So again, let's work off of reasonable touches of the channel. So are you looking to buy a pullback here? No, it's price rejection of the channel. Are you looking to short a pullback here? Yes, good trade. Looking to short a pullback here? Well, we might be, but what happens? We don't have a trade entry. Instead, we have strong momentum against. This is one that might have cost us a loss. It's a pretty nice long setup that failed by strong momentum against. Are you looking to short after this? No, there's price rejection down there, right? You might have an anti-trade here. You might be interested in trading some of these potentially, but your next possible entry is here. And then there is no entry if you're looking to enter with downside momentum, because momentum emerges to the upside. One of the other things about, and that point is here on the chart, one of the other things about disciplined entry points is that they'll keep you out of losing trades in many, many cases. You might very well have had a losing trade here. So that's a reasonable long pullback that did not work out. Probably no great entry here. Once you have this kind, so this is, keep in mind, this is one market. So if you are trading pullbacks, you're generally not just trading crude oil or not just trading the S&P. You're trading multiple markets around this. And if you're trading stocks, you're trading individual stocks, maybe getting some intelligence from the trend structure in that in that index. But even here, even where you see a lot of difficult pullbacks, a lot of difficult action, one of the things to remember is that markets do go through, individual markets go through kind of a feast or famine approach with pullbacks. So you will see periods of time, if you're looking on the daily chart, many months. If you're an intraday trader, you will see entire days on a 5-minute chart where you don't really have a lot of great setups, or maybe you just have one setup. So you really need to be very disciplined, very focused, and don't force trades if you don't have good setups. A lot of money is lost by people forcing trades. And here's a chart where when you see these kinds of violent swings within the channels, these tend to be suboptimal environments. But here was a very good pullback where you had, look, and you can see this, if you've been patient, you had a long entry here, you might have had a long entry there, and that did not work out. You do not have a short entry here. You have nothing to do here. You have no reasonable trade here. But if you've been sitting on your hands very patiently, you then notice this is something new. This is new momentum, and this sets up this nice short. And you might also be willing to take this short here, but you get no continuation. You do, however, probably get a 1-hour target out of it. And then new momentum to the upside. And you're looking to buy there, but you probably, July of 2018, I don't remember what trades we did then. I don't think we had an entry there. I think it's been a long time. I think maybe we were looking for a breakout above that small bar, and we did not get it. Here we are now into a sustained downtrend. And then look what happens. Once you have this momentum shift, then you start to have a run where feast or famine. This is the feast phase. So once you have sat through a couple years of maybe 1 or 2 trades a year with the market, and then it rolls over into a clean trading environment, don't be afraid to capitalize on that. Don't be afraid, even though you say, here's one pullback, here's the second pullback. Am I going to take the third? Yeah, given how this market had traded for so long, I would not be concerned about doing that. Then you have this longer pullback here, number 4, and that also is typical, right? Remember, that's one of the principles, that you will have these, you'll start to have complex pullbacks as the trend matures. And then you might have like a much more complicated, complex pullback, and this is still a valid trade. You would be less willing to take this trade, sorry about the right click there, up here. So you want to, what you might see as a very sloppy pullback here with number 4 is viable in a mature trend. So this chart ends March 2019. No trades here, no touch. So just waiting for the touch of that upper channel is going to keep you out of a lot of market action, and will get you into a trade like this or like this. And no pullback here. Here is an ante. Actually, let's clear the lines. This is a very tradable sell ante. Here's a sell pullback. So here's the reality of trading. You might have shorted after this kind of sharp move here. You might have been willing to short after just a few bars. If you had, I think actually this bar, so there's an issue with the bars on this chart. These are the actual settlements from 130, and I believe this bar may have closed more down there. I'm actually not sure, but you will see, particularly with gold or crude oil, it's not 130 for crude oil, I'm sorry, I was thinking gold, or some of the softs, that you'll see bars that look different the next day than where they were at 4 o'clock. So sometimes you will see failure, what looks like a failure that was not actually a failure in real time. But this is also worth illustrating from the point of, kind of messy real world trading, that this might have hit your 1 hour target. If it did not hit your 1 hour target, you're probably not holding on that kind of failure. So you're probably not in for that move. And if you just look at the chart, you might say, oh, that's a really nice short entry, and then look at how it collapsed. But this bar here, which would have been your entry bar, would have caused you some issues. Not a loss, or if a loss, a very small loss, maybe a 1 hour profit, but depending on where your stop was, but you're probably not in for that big move. And then here, just kind of bad hair days, just moves to the channel. You might have had a, let's look here. So I have a small thing here. Look at this. This is this is kind of interesting, because we're flirting with a very visible support level there. And we do come down there with new momentum. And even though we don't get to the Keltner channel, that's a kind of trade that I would be interested in looking at taking in real time. Now, in this case, it did not develop. We just ended up trading sideways. But here's the big picture. So that was here. But that little chart is this area of the chart. And notice what happens here. You break down, there's a high and tight, in this case, low and tight pullback. Here's a longer pullback. Here's a pullback. You're going to trade pullbacks after gaps like that? Probably not. This is where crude oil actually went negative. This is a back adjusted chart, so the price levels are not correct, but this is not the kind of tradable action that you would trade with pullbacks. And that's also one of the benefits of this approach. Remember, we're not looking at something that gets you in for every single move. What we're looking for is something that gets you in where there's the highest probability moves. And when a market becomes super emotional like this, it's the statistical edges kind of fly out the window. So this is not the kind of action we want to be involved in. But then look here. Here's a pullback off of the upper Keltner channel, and this action here in July of this. Where was that? Got it. Okay. So yeah, that's here. And then notice what happens here. You're not really able to make convincing highs, so you just stop trading this market. You probably have a failed trade here, failure by strong momentum against, but that's information, and that tells you that this is a market that what you're really waiting for is some clear sign that something is different. And one of those signs, if you've had a market that has chopped you up for a while here, and notice what happened. We're switching feast and famine, right? We're switching from this very dynamic environment to now this very choppy environment. So one of the things that you can do to avoid getting chopped in the noise is to simply wait for a successful pullback. And that's a lot of the testing that happens around the edges of trading ranges and the failed breakouts. You got to be comfortable missing that first trade. Have you heard that before? And so maybe this is a trade that you don't take, but what this does, that trade is here. What this does is it then sets you up to look to trade pullbacks to the upside here for a considerable length of time, and that keeps you on the right side of that. So, and of course, I am giving you the rest of the slides here into current market action. And as you look at these, you have the PDFs you can flip through. As you look at these, remember the point is not to be in every move, but the point is to select the type of market action that will really give you the best chances of the highest probability trades. Also, one of the clearest, and the reason I use this market is that one of the clearest examples of climactic action is what happened here in crude oil in early 2022. And then also we had the stabilization that now appears to be leading to further upside. And now we can maybe start to look for pullbacks in crude oil. That's the way this game is played. This is not the case where, a lot of times what people think, let me just go back to so like I'm going to draw what people think they think you'd have a pullback here, a pullback here, a pullback here, a pullback here, right? You would think that there would be a pullback every 2 months in every market or something like that. It's not the way it works. Sometimes there are pullbacks every month, every 2 months, and sometimes there will be strings of these in a row. And I have not, when I picked the S&P, when I picked crude oil here, I haven't picked like picture perfect examples. This is really messy real world trading. I'll tell you, in both of these time periods, there were easier markets to trade, which is why you probably need to be looking at a basket. What's a basket? I'd say at least 4 or 5 different markets. If you trade futures, if you trade currencies, 4 or 5 different markets. You don't just want to focus on one thing, because if you do, you're going to go through long periods where you don't have many trade setups, or where you're in an environment where trade setups are failing and you need to wait for the market to clearly shift its momentum. I'm not going to go through these next slides. I'll leave them for you. And yes, these slides are available. These slides are available right now in the handout section, so you can download them. If you're in the session today, you can download them. If you're looking at this after the fact, we will provide these slides, but this is very interesting. This is the Dow Jones, and you can see the time axis down there. It says October of 21, 22. Are you getting suspicious now? This is 19. So this is, and that's the reason it's a line chart. We don't really have reliable open high-low close data. We just have the dark line here, and you may never have seen a chart like this. This is the daily closing price of the Dow Jones Industrial Average in the 1920s, leading up to a very historic event in 1929. What I want you to do as you look through this, now I'm not suggesting that you go look for specific trade setups here, but do notice that a lot of things are consistent. So first of all, the Keltner channels, because they use true range, the Keltner channels actually would be wider because we have the high and the low of the bar that is lost. So what we're looking at here is we're calculating a range off of close to close, which is better than nothing. It does somewhat respond to volatility. You will see the same patterns that we have talked about on candlestick charts in this very old data. This is verification that the same principles are operating in markets in all time frames and in all periods. So, okay, this chart here from 1925, 1926, look here. You have pullbacks here that were probably tradable. You had what appears to be a little bit of a climax. It's a little harder to read a climax on a close only chart, but at least pretty clearly you're not looking to buy a pullback here. Do you have a losing pullback trade here? Maybe. Pullback trade here, complex pullback here, pullback trade here. So you will see that these principles of the market becoming overextended and then kind of floating back in and resetting, that those continue through all periods of market action. So that is a wrap, folks. Really appreciate your time with us. And I hope this is useful. I hope this is interesting. This is the, I hope more than interesting, I hope it's useful. These are, there are so many different ways to look at markets. There's so many different ways to trade. It's impossible for me to tell somebody this is how you should trade. But what I can tell you with a very high degree of confidence is that the in the 6 days we've been together, the patterns, the principles, this has really been the core of my approach to understanding how markets work and how markets move. And this is, this can be a strong foundation, even if you choose to trade some way completely differently. Let's say you choose to be somebody who wants to only trade those climaxes at the end of the trends, which I'm suggesting that we avoid, but maybe you want to only do that. You'll still find these principles are powerful for rounding out your understanding of market dynamics. And I look forward to your feedback, share thoughts with us, and we will see you back for another course sometime in the future. Thank you.